Hey everyone, quick break to tell you about something I've been working on. Here's a stat that stops most advisors cold. Research shows advisors don't usually get fired for bad performance, they get fired for bad communication. You already know you should be reaching out to clients more consistently. It's just finding the time to write something worth sending. So I'm here to help, and I built something to fix that. 26 to 30 advisor-ready newsletters and topic-based bundles, professionally written, enough to send your clients regularly for an entire year. There's no market commentary, no recycled cliches, just real behavioral finance, the psychology, the meaning, the decision-making, the stuff that actually helps clients think and behave like better investors. Make them your own, hit send, and you're done. You're not just filling an inbox, you're reinforcing your value between meetings and building real trust. To learn more and to buy yours, check them out at orionbefi.com. That's orionbefi.com. And if you have any more questions about this, reach out to me at daniel.crosby@orion.com. Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and I'm joined today by Alex Edmans, a professor of finance at London Business School and one of the world's leading voices on market psychology. He's the author of Grow the Pie, a Financial Times Book of the Year, and May Contain Lies, an Amazon #1 bestseller. His research has been shown up in the Financial Times, Wall Street Journal, the BBC, and he's advised sovereign wealth funds, pension funds, and asset managers around the globe. He's spoken at Davos, testified before the UK House of Commons, and reached millions through his TED Talks. We are here today to talk about his new book, The Madness of Markets, which I am thoroughly enjoying, which will be out in about the time you're listening to this podcast. Alex, welcome to the show.
Thanks so much for having me on, Daniel. It's great to be here.
No, so it has been a long time since I've enjoyed a book as much as I've enjoyed yours. It's, of course, a deep area of personal interest for me as well. You and I have both written books on how crazy markets are. And if markets are as mad as you and I suggest, why do we still see that most active managers have such a difficult time trying to beat markets?
Well, first, thanks so much for your kind comments. As an author yourself, you'll know that if you spend many years investing in a book, it's always gratifying when readers enjoy it. But then to your question, I think this could be for a number of reasons. So first is that many investors just don't know the madness. They might be following the wrong strategies. So they might think, well, crypto's the way to go. I know that this friend or this influencer made a ton of money. They may think, well, you only live once, no return without taking on risk. And so they might take the riskier strategies. So the reason why you and I write the books is to show, well, actually, this is what the evidence suggests. So not everybody is following the evidence. The second is, even if you do know the evidence, it could be difficult to put on the strategies for a number of reasons. Number one is it goes against other behavioral biases. So one of the biggest biases that people exhibit, including myself, is the disposition effect, which is we like to sell our winners and we don't sell our losers. It's really painful to take a loss because we admit that we just made a bad decision. And this goes against a quite successful investment strategy, which is momentum, which is actually winners continue to soar. So you shouldn't be taking your winners, and losers continue to sink. So you should be cutting your losses, but that's just difficult. And another reason is that these strategies, which are tried and tested and documented by evidence, they still only work on average. And it's easy to get cold feet. So yeah, there's tons of evidence out there that stocks beat treasury bills over any reasonable time period. But in a short downturn, people think, I'm going to get cold feet, I'm going to exit from stocks. Another common strategy is value investing or contrarian investing. Right now, that might involve getting out of tech and getting out of AI because everybody thinks there's a bubble. But then when your friends are still invested in it, you think, well, am I missing out here? It may well take many, many years for this strategy to pay off. But when people are saying, well, why are you not in tech? It's quite difficult to resist that crowd.
So, Alex, this may resonate with you. The other day, I was looking at my accounts and I was having a conversation with my wife, and I was thinking about how much more money I would have if I had followed the advice I had given to others in my books. If I had been able to do the things that I have been writing about for years with perfect clarity, I would have so much more money than I do today. And yet even so many people don't know, as you suggest. And then even those that do, the reason that these strategies work is because they're behaviorally difficult to implement. Yeah, it's a great point. It's a great point. So in the book, you give lots of really fascinating examples. The book is exceedingly well researched. You talk about things like the weather moving markets, the way that markets move in the aftermath of a soccer loss, the mood that we're in, all of these sort of quirky little things moving prices. Now, is there any signal here when you're telling these stories about how something like a sporting event or the weather might move the market? Is there any signal there for the average investor, or are you simply making a broader point about our own emotional weather and how that may color the way that we think about markets?
It's more the latter. It's the broader point that our emotions may color our behavior. So how did I get into behavioral finance to begin with? It was this crazy soccer paper. So this was my PhD thesis at MIT. And normally a conversation starter is not my PhD thesis was about, but hear me out because this might be more interesting than the standard thesis. So I wanted to know, well, does the market get affected by emotions, or is it driven by fundamentals, profits and dividends and all the things my MIT professors were emphasizing? I had worked at Morgan Stanley, so I saw the human side, and I thought that what I was being taught didn't match what I saw in real life, and so that's why I wanted to show that psychology matters. But actually showing that it matters is difficult, because what affects psychology? You might think, well, investor mood depends on things like a pandemic, or an election result, or a plane crash. But if you show that the market fell in those circumstances, that could be nothing to do with psychology. It could be purely economic. So a pandemic locks down the economy. And so why might the stock market go down? It's not that people are upset because they're at home, but it's just there's less economic activity. So this is why I and also other researchers looked at supposedly wacky things like sunshine and clock changes and soccer results, because they shouldn't have an effect on fundamentals. So except for perhaps agriculture, sunshine doesn't affect an economy. And apart from, say, replica merchandise and maybe beer consumption, again, soccer results shouldn't affect the stock market. And so what I found was that when a country gets knocked out of the World Cup, the market falls systematically the next day, even after controlling for what's happening in the world market. And so what I find is 0.5%. And you might think, well, 0.5%, that's not that much because the market can go up or down by 4 or 5%. But why the market moves so much is because of news on tariffs or news on the Fed raising or lowering interest rates, not something like soccer. That 0.5% applied to the UK stock market is £13 billion. So this shows that emotions really do affect prices. And so while I wouldn't trade on this, and I wouldn't trade on weather or clock changes, what this does highlight is the role of emotions and psychology, and then that opens the way and opens the door for the other trading strategies that you might have, such as those which are exploiting overreaction, such as contrarian or value investing strategies.
So coincidentally, we're recording this hot on the heels of the World Cup having concluded. Did you follow it this year, how it mapped onto the winners and losers this year?
I followed it for only a couple of games. So one was the England getting knocked out against Argentina. And the market fell immediately upon open the next day by 0.5%. And actually, Yahoo Finance said part of the reason was was England being knocked out. So it was emotions. But I did follow it much more carefully in 2014. So I did an interview with CNN's Richard Quest at the start. And this guy, if your listeners have seen him, he's not shy about his views. And when I said soccer could affect the stock market, he said, really? This is crazy. And he grilled me, as obviously he should, but he was open-minded. And so when I explained the evidence, he started to come around. And at the end of the interview, he said, "That was a great interview. Please track the 2014 World Cup and keep me posted. And if things play out as you predict, I'll have you on again." And he had me on again not once, but twice. So it turned out that in 2/3 of cases, after a team was knocked out, the market did fall significantly the next day, more than the world market.
I wish I had known about this strategy just weeks ago. I could have been very wealthy. Now, you mentioned there in your last comments, you mentioned overreaction. The book has a very useful framework. You sort of subdivide our reactions to markets, our behavioral biased reactions to markets into overreaction, underreaction, and misreaction. If you could just give us a quick synopsis of each of those three and what they might look like practically for investors.
Certainly. So overreaction is one way in which markets are inefficient. Markets take into account information that they should not. So something irrelevant like a soccer result or the weather, it does drive stock prices even though it doesn't affect fundamentals. And this you can also apply to more standard pieces of news. For example, a company rebrand, let's say Allbirds changing its name to Newbird AI, that led to a 582% increase in the stock price just because it contained the word AI, even though there was no evidence it had any expertise to pursue this new strategy. If you're making trainers, that is different from trained models, which is what AI should be about. But we again saw an overreaction. Sometimes the market might overreact to old news. So there's an example where the New York Times had an article about a potential cure for cancer. Not surprisingly, one of the companies involved, the stock price went up 7-fold. And you might think, well, that's rational because a cancer cure could be game-changing. But that same story had been reported in the New York Times a few months earlier. So again, you find overreaction to something which isn't that newsworthy. But then on the flip side, the other reason why the market might be inefficient is it does not respond to something when it should. So in a trial, you have to tell the truth, the whole truth, and nothing but the truth. So overreaction is responding to nothing but the truth. Some things which are irrelevant get into the price. But underreaction is you're not telling the whole truth. So the market is not responding to relevant stuff. For example, some of my work, you mentioned my book Grow the Pie, was on sustainability factors such as employee satisfaction or your environmental record, how you treat wider society. These things do matter for long-term financial performance, but because some dismiss them as woke, they don't pay attention to them. So why are people getting excited about, say, NVIDIA? They'll look at, say, semiconductors being in demand. They might not look so much at corporate culture, so the market might underreact to that. And the third type that you mentioned is misreaction, and that's not the market getting it wrong, the market being overpriced or underpriced, but us investors getting it wrong. So one of them is the disposition effect. As I mentioned earlier, we put so much weight on the purchase price. We're very unwilling to sell at a loss, but we will lock in a gain. But really, the purchase price does not matter. What matters is what is the stock worth now compared to today's price. Those are the only things that should be affecting our decision. Another thing that a lot of researchers found is that we just are overconfident. We trade too much. We think we have great ideas. We think, oh, NVIDIA is going to go up because of semiconductor demand, not knowing that the market already knows this. And the people trading NVIDIA already are analysing the semiconductor industry every day, so we might not actually have an advantage compared to the market.
So I want to pull on a thread that you just mentioned there. You talked about some of the research that you put forth around employee satisfaction and other variables. I know there's been research, maybe it was you before we were acquainted, but I know there was research into Glassdoor ratings and that these were somewhat reliably correlated with market performance on a look-ahead basis. Is wokeness the reason you think that the market keeps ignoring evidence for these sort of behavioral data or these sort of, I don't know what else to call them, sort of fringe data? Why are these being ignored if there's signal there, if there's alpha to be had there?
Yes, I think wokeness could be a reason, but I think it might be even deeper than just wokeness, because this has happened for a very long time. So again, this was something I looked at during my PhD at MIT. Again, the professors were saying we analyze profits and dividends and sales, but my work at Morgan Stanley, my time there, showed that human capital really mattered. So the main asset that Morgan Stanley had was its managing directors and vice presidents and analysts, and also corporate culture really mattered. So rational economic man or woman should have just been motivated by the financial incentives, which were huge. You join at 21, you can get big bonuses and promoted to associate and vice president, but how people treated you really mattered. So if the boss just said thank you, or if she gave you a debriefing on the way back from a meeting, that really mattered, perhaps sometimes more than the financial incentives. So when I was at MIT, I wanted to look at the link between employee satisfaction and long-term stock returns. I used the list of the 100 best companies to work for in America, and I found that over a 28-year period, these companies significantly beat the market, and I did some other tests to show it's more causation than correlation. But the first journal that I sent it to said this paper is a clear reject. There is simply nothing creative or innovative about this paper. And so right now it's my most cited paper by far, but back then people thought, well, you can't ever beat the market because people thought that markets are efficient. And if you could beat the market, you should not be able to beat it on something fluffy like employee satisfaction. So while people didn't use the word wokeness back then, they thought the true value of a company is in what we see, the tangible things, rather than something intangible such as corporate culture. Feelings don't really matter. We can just incentivize people if they are otherwise unmotivated. And then even after my study came out, and therefore you think there should be free money on the table and everybody should be investing on that basis, it still is something generating alpha. So my study was replicated 10 years later, and you still get payoffs to investing in employee satisfaction. Right now, as you mentioned, Daniel, you don't just need to look at the best companies to work for lists. You can look at Glassdoor ratings and reviews. There's many other data sources which all find consistent results. And I think it could be that there's this wokeness concern, which is that these companies are fluffy, they're distracted from the bottom line, they're too much about serving employees and not shareholders. And then more charitably, it could be that people do recognize that corporate culture matters, but it's just difficult for you to know what to do with it. So if sales growth is up by 5%, maybe in your spreadsheet you increase all the numbers by 5%. But if I know that the workers are happy, how do I change cell C23 in my spreadsheet? And those who do want to measure corporate culture, they might look at tangible things like diversity. They might look at the percentage of women or ethnic minorities in the workforce, not really knowing what matters is more cognitive diversity. So it might be that I'm more from an arts background and you're more from a science background, and that can actually contribute more to diversity of thought, but there's no numbers on that. So we do default to more simple and tangible measures.
So interesting to me that, those two things, first, perhaps dismissed because it's too fluffy, and then secondarily dismissed because it's hard to operationalize. It's hard to quantify. Okay, well, there's a good culture here. There's cognitive diversity. There's gender diversity. What does that mean for my model? What does that mean for my DCF model, right? Fascinating. And I'm excited to go check out that paper now and add to those numbers. So I would be remiss if I had an expert in market psychology on my podcast and did not take an opportunity to talk, of course, about AI. I'm curious on your take on AI and where we are on the spectrum from, true revolution to mania.
With many things, I am more in the middle and balanced. And this is not just the standard academic fence sitting, but the fact that I do like to see both sides of the argument rather than just only one side. So in the general theme of the book, I think you can beat the market, but you do need to be disciplined and you shouldn't be trading all the time. And then similarly here for this question, I do think it's a bit of both. AI is the future, but it could well be that we are in a potential bubble. So why do I think that? Is that historically, what you find is the market tends to get the direction right, but the speed wrong. So when new technology comes around, it does change the world, but changes it more slowly than people think. So back in 2000, Cisco overtook Microsoft to become the most valuable company in the world. It was trading on massive price earnings multiples, which would be justified if Cisco grew sixfold within the next 5 years, which is what they thought they would. Cisco did grow sixfold, but it took 25 years. So Cisco was making routers and switches, and this was the internet economy, and the internet's obviously transformed the world, but more slowly than people think. So not everybody is comfortable doing their banking online. At least they weren't back then in 2000. There's some of the older generation which might not embrace this new technology. Similarly with electric vehicles, we saw an EV bubble in 2020, 2021. Yes, this has to be the future given climate change, but there are concerns about battery life, the lack of charging infrastructure. And then right now, in terms of artificial intelligence, yes, in theory, you might think AI financial advisors are better than a human because they're unbiased and they can consider lots of different perspectives. But there are certain things that people just want to trust to a human, even though that human might only be one particular perspective. So what then did I do with my own portfolio? Because the proof of the pudding is in the eating. I was trimmed down my tech positions around November last year. So why? Part is I did think these valuations were rich. Another part was my tech portfolio done very well. And it could be that I end up selling too early. But that's fine because I would rather capture the gains that I had done and risk missing out on another 10 or 20% more rather than risk another crash like we've had in the past. And that is also linked to something else which is important, which I think doesn't get emphasized, is people say, well, this is a good stock or a good fund, but it's only good relative to your objective. And we have investing gurus dishing out advice on social media, not tailoring it to people's objectives. So one of my biggest objectives, I've got a massive mortgage coming up for refinancing in a year's time because I bought my house in 2022 on a 5-year mortgage, and I want to make sure that I have a lot to pay down that mortgage because the rates are going to go up compared to what they were in 2022. So to lock in the gains that I had made up to November last year and then put them in some safe assets, I think that is good for my particular objective. Whereas if you were somebody without that big debt that I have, maybe you could have let the tech stocks run on a bit further.
Yeah, I like that. Your mileage may vary. I love what you said about getting the direction right, but the speed wrong, right? There is information there. Maybe it's directionally right, but it's on a different timeline than we had presupposed. I also like to remind people that the internet changed lives, airlines changed lives, and that doesn't mean that pets.com was a good investment or that the average airline has been a good investment. I think sometimes we conflate life-changing technology with a particular stock being a good buy or not, and those are different conversations. So, question here for you, is there a behavior that looks like discipline, but is really just bias wearing a better suit? Is there something that people do where they think they're being prudent, but it's really suboptimal and it's just bias by another name?
I think there's loads of behaviors that would fall under that category. So that was one of the motivations for the book, but let me not be greedy. I'll try to limit myself to 3, of which one I hinted at before. So one of them is the disposition effect, our reluctance to sell at a loss. And why can this be sort of justified? You can say, well, I'm being patient. I've got long-term conviction. I'm not going to allow short-term volatility to drive me off course. But this could just be burying your head in the sand and just not facing up to reality. You made a bad decision, just cut your losses. Annie Duke, the poker player turned psychologist, she's got a great book called Quit, just about knowing when to walk away, and so it's actually prudent rather than showing lack of conviction. Number 2, and this is more new, is the idea of holding on to lots of cash to be prudent. So it is true that sometimes cash significantly outperforms stocks, but if you look over any reasonable time horizon, one of the biggest inefficiencies in the stock market is what's called the equity premium puzzle. You look at the average return on the S&P 500 and you compare it to the average return on Treasury bills. For example, in the last 10 years, one's been 15% and the other's been 3%. Now, defenders of efficient markets may say, well, that makes sense because equities are risky and this is just reward for risk. It's no more, no less. But actually, when people have crunched the numbers, even of assuming a large amount of risk aversion, that difference, that 12% difference, and maybe in other time periods it's 7%, that is just too large to be justified by risk. So what this suggests is that the stock market is good value over any reasonable time horizon. So one of my big pieces of advice in the final chapter of the book, where I give out 20 big investment tips, is just play the game. Be in the game. It is better to put your money in equities rather than sitting in idle and cash. If your brokerage has a cash sweep, then try to have it automatically reinvesting. Sometimes if there are dividends or takeovers, then you just have that cash sitting idle. Do play the game and do be invested, because the returns that you're missing out on can indeed be significant, especially with the power of compounding. The third of a final one is constant activity, which masquerades as diligence. So people think, well, you snooze, you lose, and so we want to trade, and we think with all of these great insights, we hear this stock tip, we hear this piece of news, we hear what our friend who's a fund manager says. But again, when you're investing, you're trading against people who are doing this for a living and have far more information than you. So even though I'm a finance professor and should understand finance, I buy very few individual stocks. So yes, I could do a valuation model pretty well, but I don't have the inputs for that valuation model because I'm not meeting CEOs every day. I'm not walking factory floors and talking to employees. And so actually to trade a lot in individual stocks, the evidence suggests that this actually loses more often than it wins.
Yeah, thank you for that breakdown. I think it's so important because I think some of the most insidious and damaging behaviors are the ones that look positive on the surface, that look, ostensibly beneficial or prudent. It becomes very easy to lie to ourselves about the things that we're doing. And ending now, my last question, let's talk about lying to ourselves. I mean, I think the gift of a book like yours is that it should call us to do a bit of a self-examination, a bit of a self-audit. I love Jason Zweig's comments on this. He talks about oftentimes behavioral finance is used as a window onto other people's behavior, but he says we should use it as a mirror to our own behavior. If someone was going to use your book like a mirror, what is one practical thing that they could do to better understand themselves or do a bit of an honest self-audit?
So in the UK, you have this game called pool. I think, is it called bar billiards in the US, where you hit balls into pockets?
Yeah, pool or billiards, either would work. Yeah. So when I used to play, I wasn't that great a player, and so you would often get lucky. You'd try to hit the ball in a pocket, and then it would bounce around, and then it would hit into a completely different pocket, and so you'd still pot the ball, and you say, "Oh, I intended that all along." But then more serious rules were that you had to nominate the pocket that you would hit into before you shot your shot. So you might think, well, what has this got to do with investing? So what the investing equivalent of this is that before you make an investment, to write down your investment thesis, why you think the company will do well in the future. And then when you evaluate, so you evaluate relative to that thesis. And why I think this is so important is that there's a lot of evidence on what's called self-attribution bias, is that when there's success, you chalk it up to your own amazing ability, even if it's due to luck. And if there's failure, you blame bad luck. So any sports manager will say, well, if I won, it was my amazing team selection. If I lost, there was just bad umpiring calls. So here I might be buying a stock, and the stock goes up, but just because it got taken over. It was lucky. It was nothing to do with my view that its product was going to transform the world. So this makes sure that when we evaluate the quality of our investments, we are not overly swayed by luck,
and think it's skill. And then linked to that, when we see whether our investments are performing well or not, we should always compare them to a benchmark. So many people think, well, I traded and at the end of the year, I was up 7%. And that seems great. But if the market was up 10%, then just by doing nothing at all, you'd have made more money. And why I think this is so counterintuitive is if you go to a casino, all that matters is at the end of the evening, are you up on top? Did you get more out than what you put in? The benchmark is zero. But for the stock market, for investing, the benchmark is not zero because the alternative to investing is you just to hold a low-cost index fund, and that in many years could have earned you double-digit returns, so get the benchmark right.
Alex, the book is fantastic. Thank you for the gift of the book, for the research you're doing. If people want to get the book, remind us the name of the book again. Tell us where we can find your videos and your other work.
Thanks so much. It's called The Madness of Markets, Why Smart Investors Make Crazy Decisions and How to Exploit Them. So it's a bit like a cross between Freakonomics or these fun data-driven strategies, but also the psychology of money in terms of practical investment insight. And if you want to follow the other stuff that I'm doing, I'm on LinkedIn at A Edmans, that's AEDMANS, and on X, formerly Twitter, under the same handle, because there's so much interesting stuff out there about the markets, even more than I could put in the book, and more things are coming out even after I finish the book, so I am trying to post on there quite frequently.
All right. Thank you, everyone. Go follow Alex, go buy the book, and thank you again for your time. Thanks
so much, Daniel. Really enjoyed the conversation.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.